Welcome to the Explainer. Okay, let's get right into it. The market's entire playbook, it's been thrown out the window. That old strategy that worked for years, buy the dip, it's just not working anymore. Today, we're going to break down why. We're looking at the critical signs, both on the charts and in the real economy, that show a massive shift is happening right now. And let's start with this piece of wisdom because it's absolutely crucial for the market we're in. Be passionate about your stops, not your stocks. In an environment like this, protecting your capital isn't just some nice idea, it's everything. This defensive mindset is the key to navigating what we're about to unpack. So, what is the market actually trying to tell us? Let's forget the headlines, forget all the opinions for just a minute. The charts themselves are painting a really clear picture. And that picture is telling us that the old strategies are broken. Okay, let's dive into the single most important line in the sand for the big institutional money. The 200-day moving average. All it is really is the average price over the last 200 trading days. But you've got to think of it as the ultimate health check for the market's long-term trend. And this, right here, this simplifies the entire institutional game plan. It's like a switch. When the market is above that 200-day line, we're in a bull market. Every little dip is seen as a buying opportunity. But the second we cross below it, the playbook completely flips. Rallies aren't seen as strength anymore. They're seen as a chance to sell. The rules of the game just completely change. And look, this isn't just happening in some small corner of the market. We're talking about the big ones, the S&P 500, the tech-heavy NASDAQ, even the small-cap stocks. They are all below this critical line. This is a sign of broad systemic weakness. It means basically everyone, even those with diversified long-term portfolios, is feeling the heat. And if we zoom in on the short-term momentum, it's like looking at a traffic light. And right now, with these key short-term averages crossing over, that light just turned bright red. It's a clear signal that sellers have grabbed the steering wheel. So, the big question is, why is all this happening now? Well, a huge piece of the puzzle is that the speculative fast money, the cash that fueled that incredible bull run, is now quietly heading for the exits. And we can actually see this happening in real time. There are tools out there that track where the institutional money is going. And right now, they're showing that the big players are turning off the tap. They're not buying these dips. They're either selling into any little bit of strength, or they're just sitting on the sidelines in cash, waiting for the dust to settle. So this leads to one of the most frustrating and also one of the most telling signs of a weak market. Have you ever seen a chart that looks absolutely perfect, like it's about to launch, and then it just doesn't? Well, that's called a failed breakout. And they're happening all over the place. A stock looks like it's going to soar, the volume comes in, and then bam, it reverses and dives. This sends a shockwave of fear through the market. It just crushes confidence and makes other traders too scared to take new positions, which of course creates this self-fulfilling prophecy of more weakness. Now, this weakness on the charts, it isn't happening in a vacuum. It's being backed up by some very real, very serious fundamental problems brewing in the wider economy. First up, energy. The price of oil is creeping back up towards that big psychological number, $100 a barrel. And you gotta understand, that basically acts like a tax on the entire global economy. And this quote from Goldman Sachs really nails the danger here. See, higher oil prices don't just mean you pay more at the pump. It's bigger than that. They actively slow down economic growth, and they force central banks to keep interest rates higher for longer to fight inflation. And that, of course, hits everything from your mortgage rate to your car payment. And on top of all that, you have rising geopolitical tensions. The one thing the market hates more than anything, even more than confirmed bad news, is uncertainty. And when there are big questions about energy supplies and global trade, the big investors, they don't stick around to find out the answers. They run for safety. And that can trigger sudden, sharp drops in the market. Okay, so let's look at a perfect real-world example that brings all of this together. The agricultural giant Archer Daniels Midland, also known as ADM. So ADM just recently reported its fourth quarter earnings, and they actually beat expectations. Now, in a healthy, roaring bull market, this is exactly the kind of news that would make a stock just take off. But that's not what happened. Not even close. The stock actually got hammered. So why on earth would good news be treated like bad news? And here it is. This is the whole story. The market's focus has completely shifted. It doesn't care about what you did last quarter. In this nervous environment, all anyone cares about is what you're going to do next. ADM's weak forecast for the future was the only thing the market heard, and it punished them for it.
We can actually put a number on this kind of fundamental weakness using a tool called the Piotroski F-score. It's pretty simple, really. It's a score from 0 to 9 that's like a financial report card for a company. It looks at things like profitability, debt levels, the real nuts and bolts.
And here's the kicker. ADM's F-score was a 5, which is already in the danger zone. So this tells us that its financial health was already getting weaker before they even announced that bad news. It was an early warning sign hiding in plain sight. So, all of this, the technical breakdowns, the economic headwinds, this massive shift in psychology, it all leads to the most important question. What do you actually do now? Well, the strategy has to change.
Right? It is time to shift from playing offense to playing strong defense. First, and most importantly, focus on preserving your capital. Your number one goal is just to protect what you've got. Second, you have to at least consider the short side. With the major indexes this week, the path of least resistance might just be down. And third, use simple filters like that F-score to screen out fundamentally weak companies that might look cheap, but are actually just traps.
And that brings us right back to where we started. That old buy the dip market, it rewarded hope. It rewarded optimism. This new market, it punishes it. The key to navigating this is a disciplined defensive strategy that puts managing your risk above everything else.